Good morning from Saracen and Partners. Welcome to the Trustee Investment Training on behalf of CFG. We'd normally be doing this, fun enough, around our boardroom table next to our offices near St Paul's Cathedral, and would take actually 3 hours, the training session. But today you've just got us for 45 minutes, and we'll go through the form very quickly. So today it's myself and my colleague Rowena White who will be giving the training. There are three further sessions that take place over the next 3 weeks with other colleagues included, along with Tanya and Cameron Mia. Now, the principal aims of this course are really to understand the fundamental drivers of the return from the main asset classes, so bonds, equities, property, etc., and to look at the risk and the performance characteristics of these asset classes, and to really understand how they work in conjunction with one another within a multi-asset portfolio to look at the future returns and the income levels that could be applied to furthering your own charity's objectives. But also it's to enable you today to help perhaps enhance and design your own charity's investment policy statement, which may need refreshing. Now, as I mentioned, there are 4 sessions, and we're dealing with session 1 today. There'll be a chance to answer questions at the end of this session, and we'd obviously would welcome questions. Rowena will cover the investment powers and introduce you to the Compendium of investment, and I'll cover latterly the investment universe, in particular the subject of bonds. So without further ado, if I could hand over to you, Rowena.
Thanks, Ollie, and good morning, everyone. So starting off, you have arrived at a charity. You're either a new trustee or a new executive, and there's investment portfolio, and you're asking yourself, why do we own investments? Why does a charity have a portfolio of investments? Well, essentially, the main starting point for investments is essentially to protect that real value of your capital. So it's to grow the capital ahead of inflation, and essentially to maintain the spending power so that you as trustees or executives are able to spend as much as possible on today's beneficiaries whilst also preserving the real value of the capital so you can spend similar amounts in the future. Many of you may be trustees of endowment portfolios, and it may be that you need to, or a grant giving charity, you want to produce an income stream. So there's an important part to a charity portfolio is to generate an income stream, and ideally to try and grow that income stream over the longer term. And we tend to suggest, or that's most charities tend to do it through a diversified portfolio of assets, and we'll come on to talk about those range of assets in a bit. But just to look at that first point and the importance of growing the capital ahead of inflation, it's often said that inflation can be the biggest risk for an investment portfolio. And if Ollie just turned to the next slide, this slide looks at inflation over a number of decades. So it goes back all the way to 1900, and each bar is showing you the average inflation rate over that decade. So you can see over different decades there's been sort of varying levels of inflation, with some of you will remember the 1970s and the 1980s where the average inflation rate was very high. Similarly, I'm not sure how many of you on the call will have been remembering the 1910s, but again, very high, much higher than average inflation rate in the 1910s as well. And that orange line in the middle is showing you the average inflation rate over the entire period, which was 3.8%. You can see there's also been periods, decades of deflation. So the 1920s, there was a minus 2.9 average inflation rate. And also more recently, we've had periods of disinflation. So most notably, you see that since the 2000, the average inflation rate has been below that long-term average of 3.8%. So some people may say, well, is inflation really a worry at the moment, given it's below the average? But I think the next slide really just shows you the sort of corrosive impact that inflation can have on investments, and essentially why just holding cash for a long-term charity can have a negative impact. So what this graph is showing you is, if you take that grey line at the top, which is at the 100 level, that's essentially if you just had cash, were holding cash, didn't do anything with it, what would be the effect of different levels of inflation? So that dark blue line below that is showing you if average inflation rate was 2.5%, then by year 5, your spending power would be reduced by 12%, and going out 10 years, your spending power would be reduced by 22%. Similarly, if inflation was a bit higher at 5%, then what we're showing you is that by just holding holding that money in cash, then your spending power could almost be halved by year 10. So in 10 years time, your spending power is essentially reduced by 40%. So that's just showing you why sort of inflation is a big risk to investment, to sort of charities' money over the longer term, and why some form of inflation protection can make sense. If you just go on to the next slide, thanks, Ollie. So we've sort of looked at that and said, right, well, you as a charity potentially do need to invest, and your investment, you aren't going to be spending all your monies in the next year, i.e. you don't just want to have it in cash. So where do you start in terms of investment? And we've just shown you here a number of documents that are available to you. As Ollie said, normally we'd be around a boardroom table and we'd have these documents to hand to be able to give out to you. But just to say that obviously we can send any of these and links to you afterwards in terms of to find these documents. But the Charity Commission, that document on the right hand side of the slide, sends out, they put together a very good sort of route map for all trustees and executives to read about where you start with investment. Similarly, the Trustee Act 2000 is out there, which provides charities with guidance, but essentially it gives charities wide investment powers. And as we said here on the slide, trustees may now invest as widely and freely as they can do with their own money. So there is a diversified range of asset classes that you can invest in. But it's important for trustees to have that, there is that duty of care within the Trustee Act. So it's important to take proper advice in terms of what you're investing in, and apply that standard investment criteria. So are the investments suitable? Are they sufficiently diversified? And it's just important to understand whether your charity has any restrictions within its constitutional document. It may be that you're permanently endowed. But any questions, as I say, it says here, ask your lawyer, but also that's where the investment managers can come in to help, or indeed consultants. So there is certainly a range of guidance out there, and as a sort of starting step, certainly the Charity Commission document is CC14 is very useful. So you've got sort of the basis of it, and as I say, I've referred to the fact that there's a range of asset classes, and we then start with this investment universe. We've talked about investing, but it's in terms of, so where do you go from here? This is our compendium of investment, and essentially is the sort of the book which we refer to a lot within our trustee training. As I say, we would have a card copy, but also it is available online. And if anyone would like a copy of this document afterwards, please do email us. But what we've done for the purpose of this online training is to draw out a lot of the sort of tables from this document to highlight some of the different asset classes and the points we're making. But the compendium investment is something that we've been publishing at Saracen for over the last 20 years. It essentially the first half goes through every individual asset class. It looks at the asset class characteristics, talks about what each asset class how it's performed and what it's there for. But also the second half of the document then looks at how you can construct an investment policy as a charity, how you can select an investment manager, what are the different aspects you could be thinking of, whether it's risk, whether it's your ESG credentials within the portfolio, and also investment management fees. So there's a whole range of different topics to sort of look at, and it's more of a reference guide rather than essentially it's quite a weighty document, so rather to read all in one go. But as I say, it will form the basis of a lot of our training over the next 4 weeks. So going on to the sort of the first element in terms of what we're going to look at and what we're looking at today, because Ollie's going to talk about bonds shortly, and then next week we'll be looking at some of the other asset classes. But this is, as a charity, essentially your investment universe. And what we've done here is split it between the core asset categories on the left-hand side and then the peripheral asset categories on the right. And really where the difference is, if you look at the core on the left, these tend to make up the largest part of a charity's investment portfolio. They tend to be the more traditional asset classes, so cash, a range of different bonds, and then both UK and global equities and UK property. They're more of the asset classes that have been essentially in existence for longer. We have a record of how they've performed over, well, in the compendium, over 120 years in the case of equities and bonds. And as I say, those are really the sort of the main parts of charities' investment portfolio. On the right-hand side, these asset classes certainly have a place within the portfolio. They tend to be the more modern types of investment, and actually they're continuing to evolve as we speak. And particularly, you'll constantly see whether it's with hedge funds they are in favour, or there might be some different types of commodities that appear, and gold is very at the moment in vogue. But that asset classes tend to be used at different times in the market cycle. Managers may move in between them more frequently, whereas on the left-hand side, they are sort of more of the kind of building blocks that you will find in your portfolio. But as I say, for the purpose of today, we are going to be talking, Ollie's going to be talking about bonds in more detail, and then next week we'll be looking at equities and some of the alternative investments on the right-hand side. So in terms of, if Ollie, if you just go on to the next slide, thank you. In terms of laying out these asset classes and showing them on a sort of linear graph, as we've done here, what we've done is on the y-axis on the left-hand side is showing the potential return one would expect from each asset class. And then on the x-axis at the bottom there, that's the risk of loss. So we've plotted each of those asset classes on this graph in terms of the potential return and the risk of loss. So you can see cash is at the bottom there, so not expecting a huge return, but there is the sort of the least risk of any loss, although obviously you could argue in the financial crisis that it did depend which bank you were with, had your cash with. Then you move up the scale in terms of potential return. You've got government bonds there, index-linked bonds, then corporate bonds. Then you move into hedge funds, where there's a bit more of a return, but they're still trying to minimise the risk of loss. Move on to property. Equities a bit further up there, so then a greater return, but also more volatility, so greater risk of loss over the short term. And then on the far right-hand side is private equity. It's up at the top there because they don't use gearing, so there is that sort of chance of it is more risky for certain investors. But there is also, if you pick the right private equity fund, the greatest chance of a sort of large return. So that's where they hit sort of on a simplified version. That's how we would look at asset classes, and then it's sort of the job of the investment manager to blend the asset classes together to suit your requirements and sort of your risk return profile. And what we've then done, Ollie, if you go on to the next slide, thank you. What we've then done is we thought it would be interesting for you to see how these asset classes have performed. This is actually taken from our Compendium of Investment, and the Compendium has actually a lot more data than this, and it's probably nicer to see it on the slide because in the Compendium you've got 120 years of tables looking at this data. But what we've done here to simplify it is essentially to look at various periods, so over the last 5 years, over the last 10 years, over the last 25 years, and then all the way back to 1900, so over the last 120 years. And we're looking at the average annual return from each of these asset classes. So what you'll note by glancing at these numbers is that equities has very much has produced the largest return actually over all time periods, and since 1900 has beaten gilts, which is another word for government bonds, cash and inflation. Similarly, if you then move away from equities and look at government bonds, at gilts, they've performed better than cash. So it's sort of equities first, then government bonds. And then you'll note with cash, it slightly depends on which time period you're looking at. So probably don't need to highlight to people that the interest rate you've been getting on cash more recently, well, over the last 5 and 10 years has been very low. So it goes back to that point, if you look on the right-hand side with what inflation's been running at that period, that actually having your money in cash, it has been eroded given that inflation has performed better and has been higher than cash. So it has been important to be invested over the last 5 and 10 years. And that's essentially what central banks have been doing. They've been trying to, certainly with the quantitative easing, they've been trying to lower the interest rates and having very low interest rates on cash so that investors are forced into looking for sort of higher yielding, higher performing asset classes. So in terms of equities and gilts. So what this table is really drawing out that over the long term, investors have been rewarded for holding equities. But that's not to say equities are without their risks. And with our compendium, we look at that in more detail, and we've drawn out on the following slide. Just thought it would be interesting to look at some of the particular time periods where maybe those average returns that we saw on the previous slide hide sort of individual individual years where you've suffered a lot more volatility. So what we've done here is we've shown you certain time periods. So the Wall Street crash at the end of the 1920s, post-World War II, the 1970s oil crisis, the dot-com crash, and most recently the financial crisis in 2008, 2009. And we've circled some of the sort of the more extreme periods. But if, for example, if you look at the 1970s oil crisis, you'll see that in 1973, holding equities, you lost 24.3% of the value of your equities. 1974, if you thought that wasn't bad enough, you then lost 48.8%. So you essentially lost 2/3 of the value of your assets. Then in 1974, you see that huge rebound of 145.6%, but actually sort of net, that's still not, when you look at the percentages, it's still not making up back sort of all your money. So you got back about 90% of your money from 1973 and 1974. And what you could argue that actually this is his way, as I say, when you look at longer term returns, it can mask the individual volatility. So actually, if you put your money in 1973 and not looked at your portfolios until the end of 1975, you would have only seen a minus 10% loss overall. But that would have been a fairly uncomfortable ride for investors over that time period. And I think actually, for those who remember it more recently, 2008, 2009 was a very good example of the volatility of equities. So you pretty much, at the end of 2008, you'd lost the sort of will to live in holding equities and thought, would they ever rebound? But if you did hold your nerve and you were a long-term investor and could ride out that volatility, you see that they then rebounded 30.1%. So pretty much, well, got back the value of your equities. So I think this table is just highlighting that, yes, investments over the long term, you are rewarded, but you just have to remember that there is volatility out there, and not just in equities. You can see in bonds as well that you can suffer from volatility, and Ollie will be able to talk about bonds in a bit more detail, a bit more detail now. But if there are any questions later on, then do let us know. And I think, as Ollie can touch on, that if you want to ask questions as we go through, then do just send something into the chat, and we can pick those up at the end. Right, over to you, Ollie.
Rona, thanks very much for taking us through the case for investment for charities. So I'm going to talk about a very dry subject, so bear with me for the next 10 minutes on the case for bonds. So just to explain what a bond is, well, first of all, it's a loan that you may make to either a government or to a company for which you receive a coupon, otherwise referred to as a fixed rate of interest, and also the return of your capital at a specified date, otherwise referred to as the redemption date. Now, the rate of interest is really the rate of interest that the borrower can pay you. It affects their ability to repay the loan at the end of the period. The key thing here is the higher the quality, the lower the rate of interest they may pay you. And the other aspect to consider is the subject of default, and when everything goes wrong. And what that effectively means is the inability to meet the capital or indeed the interest payments during the lifetime of the bond. Now, in terms of jargon buster, because I know fund managers are prone to fall into talking about or using jargon, some few key points to mention. So when we refer to the term fixed interest, we refer to fixed income. And the subject of gilts actually is UK government bonds. And they're called gilts because if you go back, say, 250 odd years, these were issued in paper format, and each margin or the edge of the certificate was actually covered in gold, hence the name gilts. The equivalent in Germany is referred to as bunds, and in the US they're referred to as treasuries. Now, in some cases, when we're referring to US inflation-linked bonds, they can be referred to as TIPS, or otherwise known as Treasury Inflation-Protected Securities. And the equivalent in the UK is index-linked gilts, or otherwise referred to as linkers. And in some cases, if you listen to the news at 10, they talk about investment in credit. What we're talking about here is bonds issued by companies, otherwise referred to as corporate bonds. So why own bonds? Some 4 or 5 bullet points here. So the first one is to really improve on the return on cash. And as Rowena pointed out, the return on cash today is pretty minimal. And also to try and investing in bonds to try and minimize the risk to capital, because they're definitely less risky than, say, equities. The second point is to really secure an income stream to match perhaps a known liability. With fixed income, as the name suggests, you're going to get a fixed rate of income over the lifetime of the bond. A third aspect perhaps is the diversification within a multi-asset portfolio to try and stabilize the more volatile investments of, say, private equity, property, or equities. And the other aspect is really bonds perform well when interest rates are falling, or often during times of economic stress or in deflation. However, the opposite to that is obviously when not to own bonds, and that's in a rising interest rate environment or an inflationary environment. We'll talk about that in more detail in a moment. So the principal things that really matter to an investor in a bond are the four following subjects. So first of all is what we refer to as the issuer. So the lower the quality, the higher the rate of interest you'd expect to receive to compensate for the risk that you're taking investing in that company or in that government. The other aspect is the length of the bond or the maturity. So the greater the time to maturity, the more volatile the bond might be. So if you're taking a view today on what interest rates may be over the next couple of years, you can probably be pretty certain that interest rates aren't going to change measurably over the next couple of years. But if you're sitting here today wondering what might happen over the next 30 years, then there's a greater probability that interest rate policy may indeed change, and that adds to the risk. The third point is the coupon and the underlying rate of interest set by the Bank of England. Now, the price of the bond will vary depending on the current rate of interest available. Again, we'll touch on that in a moment, if I may. And the last point, perhaps the most critical one, is the gross redemption yield. Here it's about expressing the capital gain or indeed loss between the current market price of a bond investment and the redemption value, together with the stream of income you expect to get paid, i.e. the coupons. Again, we'll explore that again in more detail. So understanding the price and the yield. Now, both bonds are issued and redeemed at 100 pence, otherwise known as par. But the bond price very rarely trades at 100 pence during its lifetime. And we've shown you one example here of a government issued UK Treasury 4.75% bond redeeming in 2030. When we produced this slide, the price of the bond investment was 140.78 pence. Indeed, quite an elevated price, bear in mind the issue price of 100. Now, we need to consider understand the concept of yield. So when the yield rises, the price of the investment is falling, and vice versa. And there are two principal measurements of yield. One is the running yield, which is basically you taking the coupon, the 4.75%, and you divide it by the current price, 140.78. So today, looking at this slide, it gives you a running yield of 3.4%. However, that 3.4% doesn't take into account the capital loss. So going back to the example of the current price, 140.78 pence, that will become eventually 130, 120, 110, and ultimately 100 in 2030. Hence, you're going to be losing capital value despite getting an attractive income yield. And this is the key thing. This is the gross redemption yield, which takes into account the bond price as it approaches maturity. And if we did the sums today based on what you're seeing in front of you, the gross redemption yield is just 0.85%. So a much lower overall total return. If you bought the bond today and held it all the way through to redemption, that's your total return you'd expect to get. To try and illustrate more eloquently, perhaps, the difference in price and yield, we've taken an extreme example, perhaps, but if we take the Barclays bond issue of 6% perpetual, so there's no particular date it's going to pay you back, which obviously creates more risk. We're showing you a line graph. The lighter blue color is the price of the Barclays bond, and the red line is the yield. The bond was issued back in 2002. You can see the initial life of the bond performed very well. It rose from 100 all the way up to £1.20. But actually then we had the global financial crisis, and banks along with Barclays were considered high risk, and the investment market sold off very sharply, and therefore the price of bond fell all the way down to 30 pence from £1.20. And at that time, at the lowest point, the yield on the bond shot up in opposite direction, and the yield of the bond rose up to almost 20% in the right-hand axis. And obviously since then, with obviously stabilization effects put into place by the various central banks around the world, the yield has recovered to around 5% from a high of over 20, and the capital value of the bond has also recovered to over 100 once again. But this just helps to illustrate in extreme times how the yield and the price moves in relation to one another. The other point to really mention is the extraordinary, I started my job back in 1989. Doesn't quite cover the chart here going back to 1956. But if you take the high point in the light blue line, this is showing you the UK government bond yield going back to 1956. But in 1976, it reached a high of over 16%. And base rates at that time were around 15%. But what's been extraordinary has been the interest rate policies around the world by central banks to encourage inflation to come under control, because inflation back in 1976 was running also around 15%. Inflation today is around 1%. So the yield on government bonds, be it UK, US, Germany, Japan, have now fallen dramatically, such that the UK government bond yield is now just 0.2%. In the US, it's 0.7%, but actually in Germany, it's now negative, minus 0.5%. So this causes a huge headache for investors when they're looking to try and generate an attractive return as to whether or not a bond is a good investment, bearing in mind the paltry yields on offer. Another perhaps more detailed matter of fund analysis is the issue of duration. Now, duration really measures the sensitivity of a bond to a change in interest rates. And the longer the date of the bonds, they're generally deemed to be more sensitive than shorter dated bonds. And if we look at the example shown here, that if we have a price of a 10-year bond with a duration, say, of 6 years, that effectively is telling you that the price would rise by 6% if interest rates fell by 1%. And vice versa. So it shows you the measure of risk. So if you have a duration bond measurement of around 12 or 13, the higher the figure, the more risky the bond is and more sensitive it is to a movement in interest rates. Now, up until now, I broadly touched on government bonds. Now, I now want to focus on corporate bonds and credit rating agencies. So corporate bonds have similar characteristics to government bonds, but they're typically higher risk. They're indeed less liquid, but perhaps safer than equities. Indeed, during the financial crisis in 2008, they were deemed very risky because the corporate bond market froze. The same has been better this time around during the COVID crisis. The key thing with corporate bonds is that the credit agencies assess the risk of default by applying a credit rating. And AAA rated borrowers are deemed to be the lowest risk, and otherwise referred to as investment grade, whereas bonds rated BB plus or below are considered to be sub-investment grade, or otherwise termed junk. Companies and highly indebted governments pay higher rates of interest to compensate you, the investor, for the higher risk of default. And if we look at the next slide here, we have a simple table showing on the left what we refer to as investment grade, which starts at AAA and all the way down to BBB minus. If you want to consider, say, two investments that are AAA today, there aren't many, one of which is the US Treasuries, and the other one is actually the Wellcome Trust. There are other issues that we do hold, but there aren't many that are actually now rated AAA. If you want to know what the UK government bond rating is at present, it's just AA, having been downgraded a few years back from AAA. We do, however, consider sub-investment grade. And if we want to think about where I think we hold, for instance, Lloyds Bank 7.6% 2023 bond, that's rated BB plus. Now, we all have our own views on Lloyds Bank, but it just shows you that there are some instruments or some securities issued by well-known institutions that are deemed sub-investment grade. The last point of the slide is that not all companies who issue their own debt actually go to the rating agencies like Moody's, Standard & Poor's and Fitch and seek a rating because it costs the company money. In the case of the Wellcome Trust, they did say, but in the aid of the Charities Aid Foundation, they didn't. So they are deemed unrated. So please, when you look at your portfolio and you see a bond that's unrated, don't immediately consider that it's higher risk. It may just be that the bond could be issued without the need of the company going to the rating agencies to pay them to get it rated independently. So we've taken us through to 11:31. We've got obviously time for now some questions. I'm going to soon unshare my screen and we can then take questions. I can see people whether they're raising their hands or not.
Just had a private one come through to me, just a bit more about bonds and sort of knowing when to invest. And the question is sort of when is it better to invest in corporate bonds than government bonds? And also are index linked bonds a good investment? So I think just sort of generally on the sort of the three different types of bonds.
That's a good question. So the first one is when to invest in corporate bonds as opposed to government bonds. The key thing here is you look at the difference in the yield you can get from a corporate bond as opposed to a government bond. This is otherwise sometimes referred to as the credit spread, or the difference in yield between governments and corporates. At the moment, it's quite narrow, but actually when the difference in yield of say more than 2.5%, maybe 3%, so your average corporate bonds can provide you a 3% greater income yield than a government bond, then obviously corporate bonds are looking better value. But when corporate bonds are providing a yield of just 1.5% over government bonds, then actually they're less good value given the risk that they're taking. And in terms of inflation, I think there was a question, wasn't
Yeah,
it?
just, well, it was a follow-on, just saying sort of when are inflation-linked bonds a good time, or is, I think actually it said it's now a good time to hold them.
Yes, no, indeed. So, I mean, the issue with inflation-linked bonds is they are heavily bought by pension funds who are trying to match their liabilities against future known outgoings, and therefore the market is very, what we call, tight, and therefore they're priced very expensively because they're deemed a very attractive asset to pension funds who are trying to de-risk. For a charity, they don't necessarily need to own index-linked gilts to match a known liability because they haven't got necessarily known liabilities over the very long term. It's about meeting their objectives, and therefore there may be other asset classes that provide better inflation proofing with a bit more risk. So equities or property both have characteristics that do well in over a longer time frame in terms of matching inflation plus returns. The trouble today is obviously inflation-linked bonds are very expensive, and therefore we think on a discretionary basis that we feel there's probably better value elsewhere to be had than buying index-linked gilts. I can see one question coming through now. Maybe, Ro, this refers back to you. Is sort of, how do we know how much we should have invested in each asset class?
Yeah, well, actually, that's a very good question in terms of blending, because I've talked about the different asset classes and constructing a portfolio. And I think one of what, I mean, it all comes down to the specifics of your charity, and the different amounts and the different asset classes will depend on your objectives. A lot will depend on the time frame. So when I was showing you the different performance of equities and bonds, etc., you can see that with equities you need a longer time frame to invest because of the volatility that you get year on year. So if you are new to investment as a charity, and you're trying to sort of work out that blend between the asset classes, an investment manager should be able to advise you on that. But essentially, if you are a lower risk charity wanting to spend the monies in the next, say, 2 or 3 years, you're likely to have a lot more in the less volatile asset classes, such as bonds, such as cash, maybe some alternatives which can dampen down the volatility, because you haven't got the sort of luxury of being able to withstand the volatility and perhaps see a sort of longer, a bigger return in the long term. Conversely, if you're a very long-term charity, you've got a pot of money that you just want to protect you over the long term in terms of providing that inflation protection and being that pot of money that you want future trustees to be able to spend in the next 10, 20 years, then that's where you can afford to have a lot more in equities, because then that's where as I say, the greater return, you're rewarded with a greater return over the longer term. But we tend to say that a diversified portfolio of assets with a range of different asset classes is important, because obviously, as we've seen even in the last 8-9 months, that markets can be volatile and there are different asset classes to protect you at different times or provide the return. So I think diversification is key, not just for the capital, but also for the income. So again, we've seen a lot of cuts in some of the in equities, but you might be able to get your income from elsewhere. So I think diversification is key, and the blend of the different asset classes will depend on your specific objectives. It's also worth noting that this is, we'll be touching on that in a lot more detail in session 4. So when we talk about creating an investment policy statement and understanding your charity's objectives, then we'll come on to talk about that in a bit more detail then.
Yeah.
Thanks.
Right, there's one other question just popped up. It says, what if our charity currently just has its assets in cash, but is considering investments? How do we go about it, and where do we start?
Well, again, as I say, it's a slight sort of, especially if you haven't been, as a charity, you haven't been in investment before, it's a big step. And as I say, there's sort of lots of things to consider. But I think the cash aspect, and we have seen quite a lot of charities over the last few years, given returns have been so low from cash, recognizing that they do need to have some of their money within investments, not just held in cash. So really the best, as I say, we talked about the guidance out there on the Trustee Act and the Charity Commission, but I think it's either important speaking to a lawyer or accountant you have who may have recommendations of investment managers you can speak to. There is a lot of research you can do in terms of some of the charity publications out there. So Charity Finance, I know, publishes a list of investment managers each year, so that you can have an idea of who specialises in charity investment. But the best thing is at the outset is to be able to talk to some investment managers who specialise in charity investments, so they can sort of work with you, or it may be a consultant, to understand what your objectives are, whether you actually should be investing, as in if you're a charity who spends all their money on a very short-term basis, or you might be a spend-down charity, then investing over the long term might not be appropriate. But that's all sort of small steps that you can take, and certainly something like our Compendium of Investment is a very good starting point in terms of just reading around the material. There is a section on constructing an investment policy, understanding whether you should be investing, how you go about appointing an investment manager. But yes, and also speaking to other charities as well can be helpful.
Whilst you're talking, Ro, another question popped up actually from one of the attendees. So it was saying, for grant giving charities, will there be special considerations re-investments?
Sorry, so
for grant giving charities, will there be special considerations for investments? And I guess it's down to maybe fees and other aspects relating to how charities invest, whether they will get a better rate than, say, your private investor.
Yes, I mean, that's certainly in terms of charities tend to pay lower fees than the private investor, acknowledging that your charities, acknowledging that obviously any fees, and there can be different ways of investing and different levels of fees. So charities can go by investing passively. So what I mean by that is just buying an ETF. So you're really tracking the index. However, the only problem, the sort of downside to that is that you haven't got the advice in terms of constructing your investment policy, how to know to move between different asset classes depending on the market environment. So I would suggest with any charity that you have a range of different trustees on your board who can, maybe there are some who know more about investments so they can help with that aspect. But what tends to be the most common is for an investment manager who does charge a fee, obviously, but they tend to be lower fees than a private individual. And it will also depend on the types of investment you are in. So if you're just holding bonds and cash, then the fee will be a lot lower to, say, for example, holding equities where they're being actively picked by the investment house who is specializing in actively picking hopefully the right equities. And then on the sort of top end of the scale, I talked earlier about private equity and hedge funds, and you tend to see that the highest fees from those sides of things, because it's essentially you're looking for someone to really outperform in any market, and you can argue that potentially sometimes the fees are too high because you're trying to find someone who you're basing a lot on skill essentially, but that's where you tend to see the sort of highest fees.
Rhoda, thank you. Are there any more questions out there from anyone attending today?
Well, actually, it was I had it from a trustee I was speaking to just before the start about Brexit, Ollie, which always brings up a question currently in our client meetings. But in terms of what effect, we were just talking about generally on the different asset classes, but what effect, because we've been talking about bonds, what effect that would potentially have on government bonds, the sort of a Brexit outcome.
Okay, well, I'll try and keep my answer short. I suppose the issue on bonds with regards to a hard Brexit is what impact that will have on the UK economy. So if we feel that the Chancellor's going to borrow more money because the economic impact is going to be worse, then the UK economy or the UK country becomes much more indebted. And that obviously increases the risk, and therefore the rating agencies may downgrade us from AA down to single A, which would then mean that the cost of borrowing would increase. So a hard Brexit could have a damaging impact on government bonds. Corporate bonds are obviously very global. They get their income from not just in the UK, and therefore the more international companies may be less impacted, more domestic companies more impacted. So I think a hard Brexit could easily have an impact on the UK fixed income market, which would be negative. Thanks very much for attending, and we look forward to seeing you again very soon.
Thank you very much.
Thank you.
Thank you.